We're going to discuss all of this and more with Matt Orton, Raymond James, Chief Market Strategist. He is joining us now. Matt, great to have you on. Talk to me about your reaction to the consumer sentiment data and how the market is digesting it as well.
Hey, good morning, Madison. Great to join you. And I think we need to look at all of these surveys with a grain of salt because they change very, very rapidly. And I think there's a number of drivers, especially with respect to the noise that we're getting out of Washington with tariffs. There's also some near-term inflationary pressures with respect to food and egg prices and all of those things that consumers see on a daily basis that I think is really influencing their perceptions of where inflation is going to go and where sentiment is right now. But when you take the bigger picture, and this is something I emphasize to clients, is that the one thing that matters most to the market over the long term is what's happening with earnings. And I think we're forgetting, because of all of the noise that's out there, just how good earnings season has actually been. S&P 500 earnings are up almost 17% year over year, which is significantly higher than expectations. And critically, earnings breadth continues to increase. So you're seeing better earnings across sectors. Financials are the best contributor to earnings growth so far this year, but also down market cap. So areas of this market that I actually like, that I think benefit from the stronger fundamentals underlying this market and economy, or small caps, mid caps, all of those parts of the market I think make a lot of sense to look for on pullbacks that I think are based on some short-term indicators.
Matt, is it going to be enough though to offset the underperformance of the Mag 7?
Yeah, and so far it is. I mean, our markets are sitting pretty close to all-time high, Shauna, and I think we lose fact that the Mag 7, even though they're starting to underperform relative to the market, they haven't completely rolled over in totality. There's still certain names in there that make sense. And again, the big takeaway from all of this is that selectivity actually matters again. It matters what you own. You might not want to own all of the Mag 7, but there might be one or two companies in there that still are continuing to do well, beating earnings, have good prospects going forward. But there's a lot of areas like financials. Banks have done incredibly well. They benefit from deregulatory trends and the fact that the economy remains in a good shape. Even healthcare, I know there's issues with respect to the DOJ, but you look at medical devices doing quite well. The rest of healthcare today is actually up outside of managed care. So there's a lot of other ways you can diversify your portfolio away from the Mag 7. And the market is holding up because breadth is expanding.
But how much should you be diversifying away from the Mag 7? I get what you're saying about selectivity, but the last 2 years have taught a lot of investors that you can't really afford to not properly allocate to the Mag 7.
Yeah, it's a great point, Madison. And I think people forget too, even if they're just index investors where you own SPY or the Qs or any of the general market ETFs, you own the Mag 7 in a pretty decent weight. So I wouldn't say that the name of the game is underweighting or not owning them. I still think these are fantastic businesses. I mean, when you look for a high quality business, most of those Mag 7 companies are the perfect definition of quality. So I think you still want to own them. But I think what makes sense in this market is when you're looking to perhaps put some of the excess cash that you have on the sidelines to work in the market, or as you rebalance your portfolio and maybe think of just taking the weight slightly down from the winners that you've had in the past and rotating into where the earnings growth are actually going, into places like financials, down market cap into mid caps and small caps, even overseas. There's definitely opportunities internationally to help diversify your portfolio. And you also get a little bit less tech exposure that way too. And banks overseas are doing great as well. The name of the game is balance. How are you as an investor going to build better balance for your portfolios in 2025? Because I think that's how the market is going to unfold.
Matt, how much volatility do you expect NVIDIA's earnings to introduce into the market next week?
I mean, the market's expecting significant volatility. We've seen that play out every single time. So all eyes on Wednesday afternoon are going to be on what happens. And it's not even so much the results, it's how good is the guidance. Is guidance going to exceed already high expectations for the market? And that is what's going to determine the price movement going forward. And again, regardless of what happens with NVIDIA, I think they're going to still confirm the AI trade is firmly in place. And I think that opens up opportunities as you look to diversify into software. Some of the other AI halo names where earnings are good but got taken down because of DeepSeek, like your data center build-out plays. There's going to be opportunities, and so you want to digest any volatility introduced from NVIDIA and see where else you might be able to put money building on that theme of balance.
Let's stick with that because, and you mentioned this in your note too, that there are opportunities in AI CapEx beneficiaries. You mentioned their software. Can you get a little more specific for me?
So yeah, I think as you look at where expectations are for results and monetization, software is really the next phase. So it's not necessarily in the big behemoths of software, but when you look down to smaller, maybe smaller, large companies, mid companies, cybersecurity is top of mind. When you look at an environment that we have right now with more and more threats, more and more cyber threats, when I talk to CTOs of companies, a big line item of spending that's actually remained pretty steady over the past few years and actually starting to increase right now is on cyber defense and leveraging AI solutions within cybersecurity. So you want to own some of the cyber companies that are levered towards the best and more differentiated AI plays or AI integration. And so those names have been doing well for a very good reason. So that's one good place to continue to look or lean into as this market continues to be a little bit choppy in the near term.
Matt, real quick, let's talk a little bit about the Fed. I guess, from your view, is the Fed in a good spot right now? Is there a risk potentially of waiting too long to act again?
Yeah, Shauna, everyone loves to be, I think, an armchair economist with respect to what the Fed should or shouldn't do or what they did wrong or didn't do wrong. I think the Fed's in a fine place. The Fed has set themselves up to wait and see, and that's the exact right approach, at least I think. The economy continues to be robust. There are some cracks that are starting to form, nothing that's opening up into fissures. There's inflationary pressures, but it's all so far in the short term. So we've got to wait and see where the data comes. And I think the Fed has been very proactive in giving that message to the market, which is perhaps why once we made adjustments earlier this year with respect to rate cut expectations, we've seen the 10-year pull back. And I actually encourage clients, if you get the 10-year yield above 4.85, nearing 5%, that's the time to think about adding duration, because I don't think rate hikes are on the table. And I think the Fed's in a very good place to just wait and see how things unfold.
I want to end by talking to you about the Europe trade, which has gotten a lot of attention this week. And you noted that the growth rate for U.S. earnings was around 9%, only about 6.5% for Europe. So how should investors be thinking about the opportunity in Europe when you aren't getting paid as much to sit in European equities?
Yeah, that's a really good point. And I think when you look at diversifying into Europe, especially after the big run that European equities have had over the past, call it 3 months or so, I think you want to wait for a pullback to put some money to work. But you can be opportunistic. The name of the game is selectivity, because not every part of the European market is moving up in tandem. So you want to be careful of what sectors, call it your industrials, material companies, might be more levered to tariffs or to challenges that might come up with respect to China. And instead lean into trends that you know are going to be important. Ceasefire in Ukraine, whether or not that happens, we know countries have to spend more on defense. So there's a reason why European defense companies' earnings have been good. Lean into that. Mm-hmm. Banks are doing better because the economy looks like it may have bottomed, and you're seeing good earnings come back. So again, it's always follow the earnings as you're looking overseas and wait for pullbacks. There's no need to chase this market higher.